A man in Guelph, Ontario has run an incorporated landscaping company for 21 years. He started it at 32 with a single truck, a trailer, and $45,000 in personal savings. He invested into the corporation as share capital. He built it into a company with 11 full-time employees, $2.4 million in annual revenue, and a reputation solid enough that a regional competitor approached him in 2023 with an offer to buy. The sale price agreed upon for his shares, $840,000. He retained an accountant he had used for years, a general practitioner who handled his corporate filings and his personal return. The accountant prepared the capital gains calculation. Adjusted cost base of his shares, $45,000. Proceeds of disposition, $840,000. Capital gain, $795,000. Taxable capital gain at the 50% inclusion rate, $397,500. Added to his other income for the year, he was pushed deep into the top combined federal and Ontario marginal bracket. Total capital gains tax paid, federal and provincial combined, $194,000. You paid it. He did not love it, but he understood it as the cost of a successful exit. He signed a return, transferred the shares, and considered the tax an unavoidable consequence of 21 years of work. It was not unavoidable. Section 110.6 of the Income Tax Act contains a provision called the Lifetime Capital Gains Exemption for the disposition of shares in a qualified small business corporation, which his company was. The exemption shelters capital gains from federal and provincial tax entirely, up to a lifetime limit of $1,250,000 per individual. His capital gain was $795,000. His lifetime limit was $1,250,000. The entire gain was sheltered. His tax owing on the sale of his business, $0. The $194,000 he paid, he did not owe it. His accountant did not raise Section 110.6. The buyer's lawyer did not mention the exemption. Nobody in the transaction had any financial interest in making sure he knew it existed. He found out 14 months after the sale closed, at a dinner where another business owner mentioned it in passing. He called his accountant the next morning. The accountant confirmed it, the window to amend the return, and claimed the exemption had closed. That is not a complicated tax situation. That is the system. To understand why so many Canadians who qualify for the Lifetime Capital Gains Exemption never use it, you have to understand what the provision was designed to do when Parliament introduced it, and who it was built to protect. Canada did not always tax capital gains at all. Prior to 1972, capital gains, profits realized on the sale of assets, were not taxable income in Canada. You built a business, sold it, kept the proceeds. The tax system treated capital gains as outside the income tax framework entirely. The Carter Commission of 1966 recommended including capital gains in taxable income. The government of Pierre Trudeau implemented capital gains taxation in the Income Tax Act effective January 1, 1972. Gains were gains. You reported them. You paid tax on them. Then in 1985, the government of Brian Mulroney introduced a lifetime capital gains exemption. The original exemption was $500,000, available to every Canadian individual on any capital gain from any source. The stated purpose was explicit: to encourage risk-taking and entrepreneurship, to ensure that Canadians who built businesses, farms, and fishing operations over a working lifetime could exit those assets without surrendering a disproportionate share of the proceeds to tax. To recognize that the capital built inside a small business or family farm often represents the owner's retirement fund, the accumulated return on decades of labor, risk, and reinvestment. The exemption was popular. It was used, and then it was restructured. In 1994, the general capital gains exemption, available on any gain from any source, was eliminated. What remained was a targeted version of the exemption, restricted to 3 specific categories of property: shares of a qualified small business corporation, qualified farm property, and qualified fishing property. The exemption ceiling was set at $500,000 and remained there for over a decade. For 2014, the ceiling was increased to $800,000. For subsequent years, it was indexed to inflation. By 2023, it had reached $971,190. The 2024 federal budget increased it to $1,250,000 for dispositions of qualified small business corporation shares. for dispositions of qualified small business corporation shares and qualified farm and fishing property effective June 25, 2024. The provision today is more targeted, more complex, and more valuable than it was in 1985, and it is used by a fraction of the Canadians who qualify for it. Then two things happened simultaneously, and they dismantled the practical accessibility of the exemption for most eligible Canadians. The first was the restriction of the exemption to a narrow class of qualifying property with technical conditions that most business owners do not know about, and that most general practice accountants do not proactively flag. The Qualified Small Business Corporation tests, which I will walk through in detail, require that a corporation meet specific asset composition thresholds at specific points in time. A corporation that fails those tests does not qualify. Many corporations that could qualify do not qualify at the time of sale because nobody reviewed the tests in advance. Many corporations that could qualify do not qualify at the time of sale because nobody reviewed the tests in advance and nobody took the planning steps that would have brought the corporation into compliance. The second was the concentration of sophisticated tax planning knowledge inside a small group of tax specialists, accounting firms and tax lawyers, whose practices serve business owners with the resources to retain them proactively. The farmers in Saskatchewan, the incorporated tradespeople in Hamilton, the small retailers in Kamloops, the business owners who built their enterprises over decades, without the benefit of ongoing sophisticated tax advice, frequently reach the sale of their business without anyone having told them the exemption exists. Their clients' corporate asset compositions annually against the QSBC tests. Fewer still raise the subject when no sale is imminent, which is precisely when the subject needs to be raised. The absence of the conversation. The exemption did not disappear. Section 110.6 is still in the Income Tax Act. The $1,250,000 lifetime limit is still available to every qualifying Canadian individual. The tax savings are real, documented, and in many cases in excess of $200,000 per person. Today I am going to walk you through exactly what qualifies and what to do before the sale closes. Let me give you the foundation before the technical conditions. Section 110.6 of the Income Tax Act allows a Canadian resident individual to deduct from their taxable income a cumulative lifetime amount of capital gains realized on the disposition of qualifying property. The deduction is claimed on line 25400 of the T1 return. The calculation is done on Form T657, Calculation of Capital Gains Deduction. The gain itself is reported on Schedule 3, Capital Gains and Losses. The lifetime limit is $1,250,000 for dispositions of. The lifetime limit is $1,250,000 for dispositions of shares of a qualified small business corporation, qualified farm property, and qualified fishing property. The lifetime limit is per individual, not per transaction, not per business. If you use $600,000 of your exemption on the sale of your first business, you have $650,000 remaining for a future qualifying disposition. If you use the full $1,250,000 on a single transaction, the exemption is exhausted for your lifetime. The exemption shelters that gain from tax. What is the exemption actually worth in dollars? At the combined federal and provincial marginal rate for an Ontario resident in the top bracket, 53.53%. A capital gain of $1,250,000 would ordinarily produce taxable income of $625,000 at the 50% inclusion rate. Tax on that income at the top marginal rate, approximately $334,563. With the full exemption, tax owing on that gain is zero. In British Columbia, the combined top marginal rate is 53.50%. The math is nearly identical. In Alberta, the combined top marginal rate is 48.00%, significantly lower than Ontario and BC, due to the absence of a provincial surtax and Alberta's flat provincial tax structure. A $1,250,000 gain fully sheltered. Quebec has its own provincial capital gains deduction that mirrors the federal LCG for qualifying property. A Quebec resident who qualifies for the federal LCG also qualifies for the provincial equivalent, producing combined savings at the Quebec top rate. The exemption is the single largest tax break available to most Canadian individuals who qualify for it. more valuable than any RRSP contribution, more valuable than the TFSA over any realistic time horizon, more valuable than any other provision in the personal tax system for the business owner who exits a qualifying asset. This is where most business owners lose the exemption without knowing they were ever at risk. For shares of a corporation to qualify as shares of a qualified small business corporation, a QSBC, under Section 110.6(1) of the Income Tax Act, for conditions must be met at the time of the disposition. The corporation must be a Canadian-controlled private corporation, a CCPC, at the time of the disposition. A CCPC is a private corporation incorporated in Canada that is not controlled by non-residents or by public corporations. For most small business owners operating an incorporated Canadian business, this condition is already met. Where it fails, if non-resident investors have acquired a controlling interest or if the corporation has gone public. Condition 2, the 90% active business asset test. At the time the shares are sold, all or substantially all of the fair market value of the corporation's assets must be attributable to assets used principally in an active business carried on primarily in Canada, or shares or debt of connected corporations that themselves meet the QSBC tests, or a combination of both. All or substantially all means 90% or more. All or substantially all means 90% or more. This is the test that kills the exemption for the most business owners. What goes wrong here? Accumulated cash inside the corporation. A business that has been profitable for years may have significant cash or investment assets sitting on the corporate balance sheet. If that cash represents more than 10% of the fair market value of the corporation, the 90% test fails. The shares do not qualify as QSBC shares. The exemption is not available. This is called the passive asset problem. On the corporate balance sheet has passive assets representing approximately 41% of fair market value. It fails the 90% test. Without planning, it does not qualify. And a $200,000 investment portfolio on the corporate balance sheet has passive assets representing approximately 41% of fair market value. It fails the 90% test. Without planning, it does not qualify. The solution is purification, removing passive assets from the corporation before the sale through dividends, shareholder loans, or investment in active business assets. Purification takes time. General practice accountants, accountants who prepare personal returns, corporate filings, and HST returns for small businesses, are competent professionals doing a broad job. They are not always tax specialists. The Lifetime Capital Gains Exemption, the QSBC tests, and the purification planning required to qualify are specialist-level knowledge. Many general practice accountants know the exemption exists in broad terms. Fewer proactively review their clients' corporate asset compositions annually against the QSBC tests. Fewer still raise the subject when no sale is imminent, which is precisely when the subject needs to be raised. The absence of the conversation does not mean the entitlement does not exist. It means the entitlement has not been surfaced. Myth 2. The exemption is only for large businesses. Mine is too small. The exemption applies to any qualified small business corporation regardless of size. A corporation with $200,000 in enterprise value qualifies on the same basis as one with $2 million. A farm with a capital gain of $180,000 on a parcel of land qualifies for the exemption the same as one with a $900,000 gain. The LCG is not means tested. It does not require a minimum gain to access. For a small business owner with a capital gain of $300,000 on the sale of their shares, the exemption saves approximately $75,000 in combined federal and provincial tax at Ontario rates. That is not a trivial amount for a small business exit. Myth 3. I already used my exemption on a previous sale. It is gone. The exemption is a lifetime limit, not a one-time use. If you used $400,000 of your exemption on the sale of a qualifying property 10 years ago, you have $850,000 remaining. The remaining amount is available on any future qualifying disposition during your lifetime. Your cumulative gains deduction claim to date is tracked by CRA on Form T657 from prior years. Your remaining exemption is $1,250,000 minus your cumulative prior claims. Myth 4. I missed it on my last return. It is gone permanently for a return that is still within the normal reassessment period. generally 3 years from the date of the original notice of assessment. A T1 adjustment using Form T1, ADJ can be filed to claim the capital gains deduction that was not claimed in the original return. The adjustment is not guaranteed. For the LCG to be available, the QSBC or qualified property tests must have been met at the time of the original disposition. No amount of retroactive planning can fix a QSBC test that was failed at closing. But for a taxpayer who qualified, filed their return, and simply did not claim line 25400, the adjustment is available. The window to file that adjustment is within 10 years of the original filing for most personal tax matters under Section 152, 4.2 of the Income Tax Act where the taxpayer is applying for a reduction in tax owing. Myth 5. The capital gains inclusion rate change eliminated the exemption. The 2024 federal budget proposed increasing the capital gains inclusion rate from 1/2 to 2/3 for individuals on annual capital gains exceeding $250,000 and for all corporations and trusts. This proposal has had a complex legislative history. Regardless of the inclusion rate that ultimately applies to a given transaction, the Lifetime Capital Gains Exemption shelters the gain from inclusion entirely. A gain sheltered by the LCG is not included in income at any rate. The inclusion rate debate is relevant to capital gains that exceed the exemption or that arise on non-qualifying property. It does not reduce or eliminate the LCG itself. If you own an incorporated business, request a QSBC review from a tax specialist today. Not your general practice accountant for this specific question. A tax specialist or business transaction lawyer who works with Section 110.6 regularly. Ask them to review your corporate asset composition against the QSBC tests. Ask them whether your passive asset percentage would pass the 90% active business asset test if the shares were sold today. If the answer is no, ask what purification steps are required and how long they will take. This conversation needs to happen at least 12 to 24 months before any sale. If you own farm or fishing property, identify your adjusted cost base today. Your adjusted cost base on farm or fishing property is the amount you paid for it, adjusted for capital improvements and other permitted adjustments. The gap between your ACB and the current fair market value of the property is your unrealized capital gain. If that gain is below $1,250,000, the full exemption likely shelters it. If it exceeds $1,250,000, planning for partial exemption is still significantly valuable. A farm tax specialist. Many accounting firms in rural Canada have practitioners who specialize in farm tax, can assess your specific situation. If you have received an offer to purchase your shares or your qualifying property, do not close before reviewing your QSBC or qualified property status. A transaction that closes before the qualification tests are met cannot be retroactively restructured. Contact a tax specialist immediately and provide them with your corporate balance sheet and the proposed transaction structure. They need to assess the 90% test, the 50% historical test, and any purification steps available within the remaining timeline. Days matter. If you sold a qualifying business or property within the past 3 years and did not claim the LCG, file a T1, download Form T1, ADJ from Canada.ca. Identify line 25400 as the line being adjusted. Attach a completed Form T657, calculation of capital gains deduction for the relevant year. Submit through my CRA account or by mail. CRA will reassess the return and issue a refund of the tax overpaid if the claim is accepted. The qualification tests must have been met at the time of the original disposition. If they were, the adjustment is available. If you are planning a business exit in the next 3 to 5 years, begin the planning conversation now. The LCG is most accessible to the business owner who starts planning early. Purification takes time. Reviewing the 24-month historical test requires a 2-year runway. Structuring a family trust or a spousal share arrangement to multiply the exemption requires planning years in advance of the sale. The business owner who begins this conversation at the term sheet stage has almost no room to maneuver. The business owner who began 2 years ago has done the work. Free and low-cost resources. The CRA's Guide T4037, Capital Gains, is available free at Canada.ca and provides a plain language explanation of the capital gains deduction. Form T657 and its instruction guide are available free at canada.ca. The CRA's Business Inquiries line for incorporated business tax questions: 1-800-959-5525. Community legal clinics across Ontario provide free initial consultations on tax matters for individuals who qualify based on income. Legal aid. For farm-specific tax questions, the Canadian Federation of Agriculture and provincial farm organizations can direct members to farm tax specialists, CFA FCNCA. The Law Society Referral Service provides a free 30-minute consultation with a licensed tax lawyer or accountant, lso.ca. The man in Guelph who sold his incorporated landscaping company for $840,000. His capital gain was $795,000. His lifetime exemption limit was $1,250,000. The entire gain was sheltered. His tax owing on 21 years of work, $0. He paid $194,000 instead. The window to amend his return closed. The 3-year normal reassessment period for that disposition has passed. The QSBC tests were met. His corporation qualified. The planning that would have made the difference was never done because nobody raised the subject. The $194,000 cannot be recovered. What can be recovered? By every business owner, every farmer, every fisher, every incorporated professional reading this while the window is still open, is the conversation that should have happened before the sale closed. The exemption is $1,250,000 per person, sheltering gains that would otherwise attract between $150,000 and $335,000 in combined federal and provincial tax, depending on the province. The provision is in Section 110.6 of the Income Tax Act. Form T657 is on canada.ca. It costs nothing to download. He knows now. So do you. If this video showed you something that no one in your last transaction bothered to explain, send it to the business owner in your life who is 3 years from an exit and has not yet had a conversation with a tax specialist about Section 110.6. 3 years is enough time. 2 years is enough time. 1 year may be enough time depending on what purification is required. The gap between what the Income Tax Act gives qualifying Canadian business owners and what most of them actually claim is not legal complexity. It is a conversation that was never started. Sheltering gains that would otherwise attract between $150,000 and $335,000 in combined federal and provincial tax, depending on the province. The provision is in Section 110.6 of the Income Tax Act. Form T657 is on canada.ca. It costs nothing to download. He knows now. So do you. If this video showed you something that no one in your last transaction bothered to explain, send it to the business owner in your life who is 3 years from an exit and has not yet had a conversation with a tax specialist about Section 110.6. 3 years is enough time. 2 years is enough time. 1 year may be enough time depending on what purification is required. The gap between what the Income Tax Act gives qualifying Canadian business owners and what most of them actually claim is not legal complexity. It is a conversation that was never started. That conversation starts today.